June's job report takes the pressure away from the Fed to cut, but can they take the summer off? US job growth was unexpectedly solid in June, leading traders to abandon bets that the Fed will cut interest rates before September. The report may have bought US policymakers some time, but it's only 5 days till President Trump's tariff deadline expires. James Smith is developed markets economist at ING. James, let's start with the jobs numbers and a solid headline figure, but is there signs of weakness in the labour market?
Yeah, it is solid. You can, though, as you say, find some cracks if you look carefully enough. I mean, one thing that's been true for quite some time is that the vast majority of job gains in the US are being driven by just three sectors. A lot of it's coming from government. We saw that yesterday. Half of the job gains in the most recent month were down to government. A lot in leisure and hospitality and a lot in private health and education. That's accounted for about 90% of the jobs growth over the last couple of years, which means everything else is proving to be more lackluster. So you can find sort of rooms for weakness if you look. But I think for now, the bottom's not falling out of the US jobs market. And I think that's good news after all of the tariff noise we've had over recent months.
Well, let's stick with tariff noise, and the Fed's wait-and-see approach has been spurred over fears over Trump's trade policies. How high do you think inflation can go?
Well, it's definitely going to go higher. I mean, one of the very interesting things is that so far, inflation has proved remarkably benign since all of the tariffs came in earlier this year. We've had core inflation readings that have been sort of 0.1% month on month. That's slower than the sort of rate needed to get you to 2% on an annual basis. So very benign, but we think it's just a lag. We think the summer's inflation figures are going to be much hotter as we see the impact coming through. If we look at headline inflation, we're probably looking at 3.5%, so more than a percentage point higher than where we are currently.
On the fiscal side as well, some have labelled Trump's big beautiful bill as an economy killer. How will the Fed be raising this?
Yeah, well, I think in general, because a lot of this is just about extending tax cuts that were already in place, that were brought in back in 2017, the economic impact of the bill probably won't be sort of big one way or the other next year. But I think for the Fed, it is much more about what happens to the jobs market story over the next few months, which is much more intrinsically linked to those tariffs that we were just discussing. And of course, what happens to inflation. That's really what's going to determine where we go. The fact that we think inflation is going to be stronger over the summer probably means markets are pricing too much in for September. We think the rate cut could come later than that.
Is there a fear, though, that the Fed ends up being behind the curve?
It's certainly possible. I mean, when we talk about the jobs market, I mean, it's probably the most lagging indicator there is of economic performance. So it could simply be that, we saw a big hit to sentiment back in April time after the Liberation Day. It could be that it's just taking time to filter through to the jobs market. That's certainly the risk. Certainly, we think that the tariff-related impact on inflation will be a fairly short-lived thing. And I think as the year goes on, it will get clearer that services inflation, which is 3/4 of the US core inflation basket, is proving to be more benign. So it may well be as we get into the latter part of this year, the Fed's been on pause for a while. It may mean that it needs to get cracking. We could even see the Fed start with, say, a 50 basis point cut in December.
So what does this all mean for the dollar? Have we reached peak bearishness?
Well, I think the next week or so is going to be quite difficult for the dollar, or at least bumpy. And certainly markets are beginning to price that in, given, there's a lot of noise building about tariffs already. President Trump talking about writing to various trading partners with tariff levels. I suppose that sort of sounds a little bit familiar to what we saw in April. So it's a vulnerable point, I guess, for the dollar over the next few days. And it's going to depend a lot on what happens to that Fed pricing as well, which has, rate cuts have been priced out since the stronger jobs numbers. So, potentially a bumpy couple of weeks.
James Smith, developed market economist at ING. Don't forget, you can watch more videos on Reuters.com.